Welcome to our recap of the latest market action and significant developments over the past 2 days. The last 2 trading days have been a roller coaster, to say the least. We've seen significant volatility driven by a combination of evolving trade policy, geopolitical tensions, and ongoing debates surrounding artificial intelligence. The major U.S. stock indexes initially experienced a slump on Monday as President Trump announced an increase in global tariffs to 15%, following a Supreme Court ruling against his previous tariff authority under the International Emergency Economic Powers Act, IEEPA. The Dow Jones Industrial Average dropped 1.7%, the S&P 500 fell 1%, and the Nasdaq Composite sank 1.1% on Monday, with investors processing the renewed trade uncertainty and fears that AI could make some businesses obsolete. However, the markets showed a modest rebound on Tuesday, with the S&P 500 climbing 0.8%, the Dow also up 0.8%, and the Nasdaq Composite gaining 1%. This rally was partly attributed to a renewed focus on the upside potential of AI technology. On Wednesday, U.S. stock futures remained largely flat after President Trump's State of the Union speech.
Noteworthy public company news. Advanced Micro Devices. Shares surged 6% on Tuesday after Meta Platforms announced a multi-year partnership to deploy Advanced Micro Devices graphics processing units in its AI data centers. Meta also secured a warrant to invest directly in Advanced Micro Devices by purchasing up to 160 million shares, tying their long-term interests together. This move by Meta demonstrates a shrewd strategy of hedging its AI chip supply across multiple vendors, a smart play given current chip supply constraints and geopolitical risks. Novo Nordisk ADR. The stock tumbled 16.4% on Monday after trial results for its CagriSema drug showed a smaller percentage of weight loss compared to a rival drug from Eli Lilly. This highlights the intense competition in the weight loss and diabetes drug market, where a slight edge can lead to substantial market shifts. Eli Lilly. Conversely, Eli Lilly stock rose 4.9% on Monday, benefiting from the comparative trial results against Novo Nordisk. Keysight Technologies. The company rallied an impressive 23.1% on Tuesday, marking the biggest gain in the S&P 500, after reporting stronger profit and revenue than analysts had expected. This demonstrates that solid fundamentals can still cut through market noise. HP Inc. HP Inc. fell 6.1% in aftermarket trading after providing an underwhelming outlook for 2026, citing headwinds from U.S. trade regulations and increasing memory chip prices. This indicates that the tariff situation is already impacting corporate guidance, and we should expect more companies to factor this into their future projections. Workday Inc. Workday saw an 8% decline after its fiscal 2027 subscription revenue missed analyst estimates. Even in a hot sector like enterprise software, execution and hitting targets remain paramount. Macroeconomy and politics. The Supreme Court's decision to strike down the Trump administration's IEEPA-based tariffs created a brief market cheer on Friday, as it was hoped this would ease cost pressures and inflation concerns. However, President Trump quickly countered by announcing new global tariffs, initially 10% and then increasing to 15% on Saturday, utilizing Section 122 of the Trade Act of 1974. This has reignited trade war fears and introduced fresh uncertainty into financial markets. While the Supreme Court decision didn't address the repayment of collected tariff revenue, legal proceedings for refunds are ongoing, but are expected to be protracted. Economically, the U.S. economy expanded at a slower pace than anticipated in the fourth quarter of 2025, with GDP growing at an annual rate of 1.4%, below the 2.5% consensus estimate. This slowdown was partly attributed to a decline in federal spending during a prolonged government shutdown and a sharp decline in durable goods spending. Consumer confidence saw a slight uptick in February, increasing by 2.2 points to 91.2 after a dip in January, with consumers expressing less pessimistic expectations for the future. However, inflation remains a concern, with the Federal Reserve's preferred gauge, the Personal Consumption Expenditures Price Index, showing inflation rising at an annual rate of 2.9% in December, the fastest pace in nearly a year. This comes even after the Consumer Price Index eased to 2.4% in January. The labor market also faces mounting strain, with the unemployment rate projected to reach 4.6% by the end of 2026. On the political front, President Trump's State of the Union address focused on jobs, manufacturing, and the economy. However, fact checks highlight that some claims, such as inflation plummeting and foreign countries paying tariffs, are debatable. It's always wise to scrutinize governmental pronouncements, especially when they pertain to economic narratives.
Commodities and bonds. Commodity markets have been active, with crude oil climbing nearly 6% last week to over $66 per barrel, reaching its highest level in over 6 months, driven by rising tensions between the U.S. and Iran. Geopolitical risk in the Middle East continues to be a major factor for oil prices, with ongoing talks between the U.S. and Iran expected to shape near-term movements. Gold, a traditional safe haven, saw a significant rise of 3.4% on Monday to $5,254 per ounce amid market turbulence and geopolitical risks, and continues to hold above $5,200. Chinese precious metals traders returning from Lunar New Year holidays have supported both gold and silver prices. Copper prices on the LME have moved back above $13,000 per ton as Chinese participants return from holidays, increasing import appetite. In the bond market, yields of U.S. government bonds rose modestly, with the 10-year U.S. Treasury yield finishing around 4.08%, up from 4.05% the previous week. However, yields on long-term Treasury securities have fallen to the bottom of their recent trading ranges, with the 10-year bond testing 4% and the 30-year note dropping below 4.7% in the third week of February, reflecting a flight to safety amid increased uncertainty. Record open interest in U.S. Treasury futures and options, surpassing 36 million contracts, suggests that clients are actively hedging against uncertainty surrounding monetary policy, government spending, and inflation.
Crypto. The cryptocurrency market has faced significant pressure, with Bitcoin briefly dipping below $63,000 and XRP crashing 69% from its July high. The new 15% global tariff imposed by President Trump triggered $466 million in liquidations across the crypto market. Geopolitical tensions, tariff uncertainties, and tightening liquidity are cited as reasons for accelerating fund withdrawals. However, the market saw a bounce on Wednesday, with Bitcoin trading around 66,200, up over 3%, and Ethereum jumping almost 5% to around 1935. This rebound injected some short-term optimism, but the broader picture remains cautious, with the Fear and Greed Index still signaling extreme fear. Forward-looking insights. Looking ahead, traders should brace for continued volatility. NVIDIA's earnings report, expected after Wednesday's closing bell, is a major focus and could significantly influence the tech sector and broader market sentiment, given its substantial impact on major benchmarks. We also anticipate more economic data releases in the coming days, including producer prices, consumer confidence, initial jobless claims, and regional Fed surveys, all of which will provide further clarity on the health of the U.S. economy and potential Fed policy moves. Geopolitically, renewed talks between the U.S. and Iran are expected on Thursday, which could dramatically impact oil prices and overall market sentiment, depending on the outcome. As always, market participants will be keenly watching for any further developments regarding U.S. trade policy and how President Trump chooses to wield his tariff authority. From a technical perspective, the S&P 500 has been testing resistance around 6,900, and a failure to sustain levels above this could indicate a downside resolution. The current environment truly warrants a cautious and diversified approach.